there's always opportunities and weakness when the market's down a little bit. You can definitely get good times to buy seasonal dips, good time to buy stocks, and also sector tilt matters in the ASX, particularly the banks and the miners dominate, and both are cyclical and sensitive to global risk.
Ever since 1945, the September quarter has been the weakest stretch for the S&P 500 and the ASX. And September itself has become known as the only month with an average negative return. Why so? And what does this actually mean for investors here in Australia? Joining me to dig into this is Tiger Brokers Chief Strategy Officer Greg Boland, who's got more than 35 years of specialist experience in capital markets. Greg, what is behind this very odd phenomenon?
Thanks for having me, first of all. So there's three main things why September, particularly in the US and the third quarter, are pretty usually historically weak. The first one is seasonal investment behavior. So since 1945, the September months have had an average negative return for the S&P 500, and therefore that sort of pulls down the September quarter, July to September, also making it weak. And some of the main reasons in terms of the seasonality are sort of post-summer rebalancing. So the fund managers and traders come back from holiday and they often sell risk assets, particularly if they've gone up in value over the time they've been on holiday. So that's one of the seasonal things. Second one is tax considerations. In the US, they often follow the fiscal year end, which is the government year end, which is the 30th of September. So they'll either try and take profits before that or harvest any losses. So from a tax point of view, if you've got losses just before the end of the quarter, then you get some tax benefit from that. And also, traditionally, fund managers rebalance at the end of each quarter as well. So fund managers may be rebalancing and allocating different things to different stocks at the moment. So that's the first main one. The other thing is macro things. So often during September, there's Federal Reserve meetings, and historically, it's either a time where there's going to be hikes or adjustment lower, and definitely this can unsettle the market, and so people may sell off. This time, it may be the opposite in terms that interest rates might actually go down in September, given the low inflation numbers that we saw last week. Also, in this sort of macro theme, there's been a lot of crises around this time of the year in terms of September or thereabouts. So obviously, probably the worst one that we've seen from a television point of view was 9/11 or 9/11 in 2011 when the World Trade Centers collapsed. And that was obviously a September crisis or terrible a thing that happened. Also, Lehman Brothers failure in 2008. There was a long-term capital management crisis in 1988, and then there's been other slowdowns during that sort of September period. The third main thing is psychology and momentum. So we've had a lot of momentum higher, particularly since the April pullback because of tariffs. There's some sort of market laws that are put out into the market. One of them sell in May and go away. Another one is the Santa Claus rally, so hoping that the market will rally going into Christmas time. And one of the other ones is, and prevalent for here, is when September comes, beware, because investor behaviour carries on from one period to another. Particularly in the early autumn, and selling pressure often becomes a self-fulfilling prophecy.
It's quite striking. I genuinely don't think many people knew this, Greg, but we've also come to learn from you that Q3 overall has been a weak period for stocks globally, but this year, 2025, has taken a very different turn. Why do you think we haven't seen that dip in 2025, and what's made 2025 such an outlier so far?
I think the main reason has been this tariff tensions at beginning of April, and that's pushed the market down. So it's already had a very substantial correction earlier in the year. So maybe the market is sort of over that weakness and ready to rally higher. They feared a trade war, and that's definitely happened. And now there seems to be, acceptance that the tariffs are here to stay, etc. So the market is sort of put that hopefully behind it. Although there's still, ongoing negotiations. There's been a very strong earnings, and in the second quarter. So the second quarter earnings come out in Q3, and they've been fueling optimism for this period. And also a lot of the companies, their forward guidance has been pretty good. The other thing is there's been broad market participation. Often when there's going to be weakness in the market, a lot of people pull back from investing in little stocks, and definitely the smaller stock index called the Russell 2000 has definitely had a great run in the last month or so. So definitely things are happening for the better. So also there's an expectation, as I said earlier, that there'll be a Fed rate cut later in 2025, as well as probably one in September. So maybe 2 rate cuts.
Let's go back to earnings. I think you mentioned a very important point there, Greg. And as US earnings season wraps up, who have been the standout winners and losers all across? And tell us more about that surprise from Cisco.
Okay, so in terms of the earnings season, it comes out after the end of each quarter. So the Q2 earnings have been reported since the beginning of July for the period up till the end of June. The earnings overall have been surprisingly strong, with 81 to 90% of S&P companies beating their revenue and earnings forecasts. So 81% have beaten revenue, 90% have beaten forecasts, and making it the third consecutive quarter of double-digit growth. So the markets are definitely higher because of that. And the lead has really been technology and the communication stocks, the AI heavy names, like the Microsofts, the Meta, Nvidia, and they have done very well. Also, the financials, the banks definitely benefited from the market volatility in April. The trading arms of banks did very, very well in their reporting early in the reporting season. The weak spots have been really materials, industrials and consumer goods, and people have sort of sat on their hands a little bit worried about what's happening with this tariffs, and companies like General Motors and Nike have reported badly. So the winners have been really Alphabet, Meta, Microsoft, and the like, and then some of the smaller stocks like Shopify and Palantir have done really well. And Palantir's they delivered a 78% jump in earnings, and Shopify also showed strong improvements across their earnings, revenue, etc. So, and the underperformers have really been the energy stocks like ExxonMobil, some of the consumer discretionary ones like Deere. You don't have to go and buy a new tractor every year. So that's slumped, and Nike's had concerns about the inflation and dampening demand from consumers.
Greg, how do these US trends flow through to the Australian market, and what should local investors be watching out for in the months ahead?
Okay, so they flow through to the Australian market because often, when the US sneezes, the rest of the world catches a cold in some ways. So if it happens in the US, it often happens in the Australian market as well. And the September quarter since 1936 has been the weakest quarter in the Australian market as well, because of the global linkages, and earnings seasons hangovers, and also dividends are payable, particularly September, October. So that draws the market down a little bit. But so what does it mean for an Australian investor? Expect volatility. The market's always volatile, it's up and down. Seasonality is a tendency, not necessarily a law. So expect volatility, not doom. I don't think the market's going to crash or anything like it has in other parts. there's always opportunities and weakness when the market's down a little bit. You can definitely get good times to buy seasonal dips, good time to buy stocks, and also sector tilt matters in the ASX, particularly the banks and the miners dominate, and both are cyclical and sensitive to global risk, and therefore we should worry. They should worry about that sort of thing as well.
Tiger Brokers Chief Strategy Officer Greg Boland, some great insights and some wonderful things we've learned today for the very first time. Thank you so much for your time.
Thank you very much for having me.